We think of you as a very shrewd, a famous distress debt investor. What do you do when there's no distress anywhere?
Well, that's a great question. It begs an easy answer. One answer is that we're active providing solutions to companies that want to recapitalize their balance sheet, change their debt structure in some way, or just add additional liquidity, not distress situations, but there are cases where there's an appetite for credit and the market doesn't make it available. We're active around the globe, and there is more to do in Asia and in Europe than there is in the United States. I think we distinguish ourselves as investors by what we do when our strategy is not in great favor. Every strategy goes in and out of favor, and this is the time to try to be resourceful and yet maintain our standards. It's very challenging.
No doubt about it, Howard. Look back for a moment at 2020. You had your year-end note that sort of went through it, and as I say, it was a remarkable downturn and then snapped back up right away. To make money, you had to move really fast. About a year ago right now, I know that you had raised, I think, a record amount of capital, Oaktree Capital Management, at the time. Could you get the money out the door, put it to work fast enough?
The fund we raised was actually raised on July 1st. So the greatest opportunities were past. We used the opportunities that arose in primarily in March, somewhat carried over into April and May, we used to complete the investment of our prior fund. So we had a fund that was about 30% or 40% invested at the beginning of 2020, and we got it fully invested. And that was the best of the buying.
The market has rebounded. The economy is in the process, I think, of rebounding with remarkable speed. At the same time, it's not even. It's uneven. So let's talk about some of those disparities, particularly in things like travel and leisure. Are there still some opportunities there, perhaps? Because that seems to be lagging behind a lot of the rest of the economy.
Yes. Well, you know, the easy calls, the things that are obviously going to rebound, they're not fully back to where they were in times of prosperity in terms of their in terms of the investment opportunities subsiding, but they are, if it's clear they're coming back, they're treated as certainly coming back, and to get to higher returns these days, you have to be willing to extend credit to somebody who's not clearly coming back.
Are there any sectors you're still avoiding at this point?
No, we were open to anything. I mean, our style usually constrains us, for example, to not do technology. But other than that, we're wide open.
Howard, it strikes me that one of the things that's different from anything I think I've ever seen, maybe any of us have ever seen, is the degree to which the government, both on fiscal and on monetary policy, is intervening in the marketplace. Is that sort of a dampener on your business in the sense that, for example, when it comes to distressed debt, you've got a lot of zombie companies. I read, I think it's like 19% of the publicly traded companies in the United States right now are zombie companies, do not generate enough cash to pay off their debt. Does that really make it more difficult for somebody like Oaktree?
No, that's in short, that's the kind of situation that presents opportunities to us. If companies have no problems, no exigencies, then the distressed investor doesn't have any problem, anything to do. So we take companies which are in extremis or producing bad news, where the future doesn't look so great, and if we can buy those securities at the right price, which means a price that overestimates the problems, that's how you make money as an investor. So we don't shy away from difficulties.
But isn't there a price support under those companies, if I can put it that way, because essentially money's free? They can borrow more money, even though they're losing money. They're not generating enough cash, again, to service their debt. Doesn't that actually make it more difficult to get the right price for you?
Yes, it does. Yes, it does. I mean, the right price for us is to be able to buy things for less than they're worth. That's our goal. We need cooperation from somebody who's willing to sell things for less than they're worth. And usually you get that when the asset holders feel urgency to sell, and when there is no support, and when when yesterday's decline is viewed as merely a foreshadowing of a further decline. That's when you get to buy things at reasonable prices, And today, those things are generally not the case.
Howard, you mentioned geography before. We're seeing a resurgence in Asia and to some extent in the United States. We're not seeing it yet, at least in Europe. We're about to hear from the IMF this week. And the IMF is saying, boy, there is a real danger of a divergence in the economic rebound. Does that create opportunities for an investor like you in places like Europe?
Yes, that does. And we're active in Europe. We've had a team in London. Oaktree's been in London since '98. And I think we get a very good call in Europe.
What about currency? Where are you on the U.S. dollar? How much does that factor into your decisions? Because there are a lot of people thinking.
We don't take an opinion on currency. One of the 6 tenets of Oaktree's investment philosophy is that our decisions are not guided by macro forecasts.
So you don't worry about long-term weakness of the dollar?
Well, I worry about it for other reasons, not in saying, well, will I invest in this thing which is in pounds or rupees or renminbi or pesos or something like that, and not tactically like that. But it's a concern what the way the U.S. is behaving vis-a-vis the dollar. But on the other hand, not clear what one does about it.
Howard, there's a lot of discussion, as you know, debate even, about the possibility of inflation as we're about to add. We're in the process of adding $1.9 trillion on the rescue package, and now we're talking about another $2 trillion potentially from infrastructure plan. How concerned are you about inflation and therefore increased rates?
I am concerned. I'm not an economist. I don't trust in economic forecasts. But I do think that, look, last year we added $6 or $7 trillion to the debt. This year we're on pace to probably do 5 or 4 or something like that, and the next year. Now the relief package will add substantially. The infrastructure package is less of a worry because those trillions are spread out over at least a decade. So they're only 200 billion a week. That's all. By the way, last year it was the year the word trillion became in common use. I don't think we've used it much before that. But when a country adds that much to its debt and prints that much money and has to borrow that much money to cover the debt and refinance the debt, cover the interest on the debt and the deficit, I think historically the knee-jerk reaction would be to say, well, that cheapens the dollar because there will be too many in circulation, and we'll have to try too hard to get people to finance our deficits. Now the Fed claims not to worry about that, and I hope they're right. We'll see. They claim that the slow economy is more of a worry than a too fast economy, which would bring on inflation. Let's hope they're right. But when you, as you said earlier in the segment, we've never seen stimulus like we have at this time, and I always say that if you've never seen something happen before, you can't say how it's going to end.
And one of the things you're known for, certainly I read all your notes about, are really figuring out what you do know and what you can't know, and not trying to guess at the things you can't know. We haven't been in this territory before. A lot of people seem to be assuming maybe the debt and deficit doesn't matter anymore because the interest rates are so low. We've heard Janet Yellen just this week say, you know what, these are long-term trends. They keep it down, and so there is really no danger of inflation. Should we be worried about that analysis? Do you think that the debt and deficit still matter?
I find it, let me take the opposite side. I find it hard to believe they don't. I mean, it's like saying that we have a credit card. The United States has a credit card with an infinite balance capability, and you never have to pay it off. It sounds too good to be true. And if somebody offered me that credit card, I would look for the catch. That's all I'm saying.